Mortgage delinquency rate records Q3 uptick. The delinquency rate for mortgages on 1 to 4 unit residential properties increased to a seasonally adjusted rate of 3.62% of all loans outstanding at the end of the third quarter, according to new data from the Mortgage Bankers Association (MBA). The third quarter delinquency rate was up 25 basis points from the second quarter and up 17 basis points from 1 year earlier. The percentage of loans on which foreclosure actions were started in the third quarter rose by 1 basis point to 0.14%. The national mortgage delinquency rate increased in the third quarter from the record survey low reached in the second quarter of this year, with an uptick in delinquencies across all loan types, conventional, FHA, and VA, said Marina Walsh, MBA's Vice President of Industry Analysis. The increase was driven entirely by a rise in earliest stage delinquencies, those 30 days and 60 days past due. Later stage delinquencies, those 90 days or more past due, declined to the lowest level since the first quarter of 2020. The decline in later stage delinquencies, along with a foreclosure starts rate of 0.14%, which is well below the historical quarterly average of 0.40%, suggests that distressed homeowners may be utilizing available loss mitigation options that prevent a foreclosure start. Additionally, accumulated home equity may also be enabling some homeowners to sell their homes well before foreclosure becomes a possibility. Mortgage rates go into a slump. Mortgage rates were in decline this week, according to the primary mortgage market survey published by Freddie Mac, OTCQB, FMCC. The 30-year fixed-rate mortgage averaged 7.5% as of November 9, down from last week when it averaged 7.76%. A year ago at this time, it averaged 7.08%. The 15-year fixed-rate mortgage averaged 6.81%, down from last week when it averaged 7.03%. A year ago at this time, it averaged 6.38%. As Treasury yields decline, the 30-year fixed-rate mortgage dropped 0.25%, the largest one-week decrease since last November, said Sam Cater, Freddie Mac's chief economist. Incoming data show that household debt continues to rise, primarily due to mortgage, credit card and student loan balances. Many consumers are feeling strained by the high cost of living, so unless mortgage rates decrease significantly, the housing market will remain stagnant. TransUnion. Q3 mortgage balances up slightly while originations sink. Total mortgage balances were up 3.2% during the third quarter while total mortgage origination plummeted by 36.5%, according to new data from TransUnion NYSE, True. After recording a slight decline in the second quarter, mortgage balances increased to $11.8 trillion in the third quarter. At the same time, mortgage originations fell from 1.9 million in the second quarter to 1.2 million the third quarter, comparable to volumes last seen in the second quarter of 2014. Tappable homeowner equity inched up by 1% year-over-year to $19.7 trillion, while HELOC originations were down 28% from last year's high volumes, and home equity loan originations fell 3% from 1 year earlier. And mortgage account level delinquencies were up 15% year-over-year, the sixth consecutive quarter of increases. Following a period of historically low account delinquencies have seen 6 consecutive quarters of year-over-year increases, inching them closer to pre-pandemic levels, said Joe Melman, Senior Vice President and Mortgage Business Leader at TransUnion. Delinquencies increased across all stages, early, mid and late, and all loan types. Vintage performance, which reflects the performance of an account in different periods after the loan was granted, shows deterioration in more recent originations. New mortgage vintages are performing worse than vintages of the past 4 years. In the midst of increasing non-mortgage debt and rising delinquencies across the board, the record levels of equity available to homeowners will remain a viable solution to ease debt pressures. Infosys and Better Team on Mortgage is a service offering. Infosys NYSE INFY, is collaborating with Better Home and Finance Holding Co. Nasdaq. BETRW to launch Mortgage as a Service (MaaS), an integrated end-to-end digital mortgage white-labeled platform. According to the companies that adopt MaaS can revolutionize their mortgage operations. MaaS combines Better's end-to-end platform, which encompasses point of sale, pricing, underwriting, loan origination, closing, funding and investor sale, with Infosys proprietary digital technology. Infosys is a global leader in lending and mortgages, said Dennis Gata, Executive Vice President and Global Head of Financial Services at Infosys. Through our AI-driven operations, we help clients originate loans at significantly lower costs than the industry average. Infosys and Better offer Mortgage as a Service that will allow us to bring to our clients integrated operations and technology with significant productivity benefits. Vishal Garg, CEO and founder of Better, added, in a market saturated with legacy products that inhibit digital transformation and lead to great inefficiencies and high costs, Infosys and Better offer increased multi-fold mortgage originations at unprecedented speed. Mortgage application activity takes an uptick. Mortgage application activity was on the rise in the latest data from the Mortgage Bankers Association (MBA), which tracked the week ending November 3. The Market Composite Index, the trade group's measure of mortgage loan application volume, was up by 2.5% on a seasonally adjusted basis from 1 week earlier. On an unadjusted basis, the index inched up by 1%. The seasonally adjusted purchase index increased 3% from 1 week earlier while the unadjusted index took a 1% uptick, but the latter was also 20% lower than the same week 1 year ago. The refinance index increased 2% from the previous week and was 7% lower than the same week 1 year ago, while the refinance share of mortgage activity increased to 31.4% from the previous week's 31.2%. Among the federal programs, the FHA share of total applications remained unchanged at 14.7% and the USDA share was also unchanged at 0.5% while the VA share increased to 10.5% from 10.1% the week prior. Joel Kahn, MBA's Vice President and Deputy Chief Economist, observed, applications for both purchase and refinance loans were up over the week but remained at low levels. The purchase index is still more than 20% behind last year's pace, as many homebuyers remain on the sidelines until more for-sale inventory becomes available.